The dollar is not collapsing. Let's start there, because the collapsing version of this story is the easy version. It is the version that gets clicks from people who already believe the world is ending. It is the version that conspiracy channels have been running for 20 years, and it has been wrong every single time. This is not that video. The more dangerous version of this story, the one that actually matters to your financial life, is quieter, more technical, and far more consequential for anyone who understands what is really being said. The dollar is still dominant. The dollar still rules global trade, global reserves, global debt markets. When a country in Southeast Asia buys oil from the Persian Gulf, the transaction is almost certainly settled in dollars. When a Brazilian company borrows on international markets, it borrows in dollars. When central banks around the world hold reserves, more than half of what they hold is still dollar-denominated. That has not changed. That is not changing tomorrow. But something else has changed. Something that the headline numbers obscure. Something that only becomes visible when you look at where this system came from, how it was built, and what it was actually built on. Because the dollar's dominance was never just about the dollar. It was about a set of interlocking mechanisms that created global demand for American currency. And through that demand, gave the United States an extraordinary financial privilege that no other country on earth has ever enjoyed for this long. That privilege is not disappearing overnight, but the mechanisms that sustain it are showing fractures, slow structural fractures, the kind that take years to widen and then, one day, are impossible to ignore. That is what this video is about. Not the death of the dollar, the beginning of its becoming optional. There is a question that almost nobody in mainstream financial media is asking correctly. The question everyone asks is, will the dollar be replaced? Will the yuan take over? Will the euro finally challenge American dominance? Will BRICS build a common currency that upends the existing order? And the answer to all of those questions, at least in any near-term time frame, is almost certainly no. The yuan is not ready. The euro has its own structural problems. BRICS does not have the institutional depth to create a true reserve currency. The infrastructure of global trade and finance is so thoroughly built around the dollar that replacing it would require decades of coordinated effort and political will that simply does not exist right now. But that is the wrong question. The right question is this: what happens when the world needs slightly fewer dollars every year? Not $0. Not a world where the dollar is irrelevant, just a world where the dollar is slightly less indispensable, where the mechanisms that historically generated automatic global demand for American currency begin to operate with just 5 or 10% less force, where the network of arrangements and incentives that made holding dollars and buying Treasury securities feel like the obvious, rational default decision begins to feel just slightly less obvious. Because when a dominant currency loses that feeling of inevitability, even before it loses its actual dominance, the financial consequences are real. And they fall precisely on the entity that has been borrowing against that inevitability for decades. To understand what is actually happening, you need to understand how the dollar's dominance really worked. It starts with oil. Specifically, it starts in the early 1970s, when the United States struck an arrangement with Saudi Arabia that would reshape the architecture of global finance. The details of that arrangement are contested, and the viral version that circulated recently, the story of a single 50-year petrodollar contract that officially expired in June 2024, was largely misleading. There was no clean, formal, simple agreement of that kind. The reality was more structural than contractual, more institutional than documented. But the outcome of that reality was concrete and world-changing. Saudi Arabia and OPEC would price oil in dollars. The world needed oil. Therefore, the world needed dollars. Countries that ran trade surpluses accumulated dollar reserves because their trading partners were paying them in dollars. Those accumulated dollars needed somewhere to go. And the obvious, liquid, safe destination, the only destination deep enough to absorb that scale of capital, was the United States Treasury market. This created a loop a self-reinforcing cycle that generated demand for dollars and demand for American debt simultaneously and automatically. Oil prices rose, dollar demand rose, Treasury demand rose, American borrowing costs stayed low. The United States could run persistent deficits that would have destroyed any other economy. The privilege was extraordinary, and it was structural, not political. It did not depend on any single agreement. It was built into the operating logic of global energy markets and global capital flows. That loop is not broken, but it is weakening. The evidence is in the reserve data, and this is where precision matters, because the wrong interpretation of this data is everywhere. Both the people who see catastrophe and the people who see nothing are misreading what the numbers actually say. According to the International Monetary Fund's currency composition of official foreign exchange reserves, the most authoritative global data set on what central banks are actually holding, the dollar's share of allocated global reserves in the second quarter of 2025 was 56.32%, down from 57.79% the previous quarter. Now, before you draw any conclusions from that number, here is what the IMF itself pointed out in its analysis. Approximately 92% of that quarter-to-quarter decline was driven by exchange rate effects, not by active portfolio reallocation. The dollar weakened significantly in the first half of 2025. The DXY index fell by more than 10% in that period, its steepest decline since 1973. When you measure dollar reserves in dollars and the dollar itself falls, the measured share falls too, even if central banks made no decisions to reduce dollar exposure. So the honest version of the short-term data is not as dramatic as it looks, but the longer-term picture is different, and the longer-term picture is what matters. In 1999, when the euro was introduced and the IMF began tracking COFER data systematically on a quarterly basis, the dollar's share of global reserves was 71.19%. In 2001, at its peak in the modern era, it reached 72%. It has been declining since then, through financial crises, through currency interventions, through geopolitical realignments, through years when the dollar was strengthening and years when it was weakening. The long-run trend, adjusting for valuation effects, is down. Not catastrophically, not in any way that suggests imminent collapse, but persistently, measurably, structurally down. From 72% to 56% over roughly 2 decades. That is not a crash. That is the gradual erosion of a monopoly. Reserve currencies do not usually die in a crash. They lose inevitability first. They lose the quality of being the obvious, default, unquestioned choice. And once that quality begins to fade, the financial consequences accumulate slowly until they don't. Now let's look at the energy layer, because this is where the misunderstanding is most profound and where getting it right matters most. The petrodollar stories in the simple, viral, conspiratorial version goes like this. Saudi Arabia had a secret deal to sell oil in dollars. That deal ended in June 2024. Now the dollar is doomed. That version is wrong. It is wrong about the existence of a formal contract. It is wrong about the timing, and it is wrong about the mechanism. But the deeper story, the one that requires actually understanding how global energy trade and dollar recycling work, is real. And it is more significant than the conspiracy version, precisely because it is more complicated and more structural. What has actually happened over the past several years is not that one agreement ended. It is that the architecture of global energy trade has begun to develop alternative channels, quietly, incrementally, without any single announcement that makes headlines. Russia, after the 2022 sanctions, had no choice but to redirect its energy exports outside of dollar-denominated systems. The result was that a major oil and gas exporter, one of the largest in the world, essentially exited the petrodollar recycling loop. Russian energy revenues stopped flowing back into dollar reserves and treasury markets at anything close to the previous scale. That is not a small development. Russia was one of the largest holders of US treasuries before 2014. It is effectively zero now. China, as the world's largest oil importer, has been building parallel infrastructure for non-dollar energy settlements since at least 2018, when the Shanghai International Energy Exchange launched yuan-denominated crude oil futures. By early 2026, India, the world's third largest oil consumer, was settling significant volumes of Russian crude purchases in Chinese yuan and UAE dirhams, bypassing the dollar settlement system entirely. China's cross-border interbank payment system, known as CIPS, processed the equivalent of 245 trillion yuan in transactions in 2025, real, operational infrastructure that exists specifically to conduct international settlements outside of dollar-denominated SWIFT channels. Saudi Arabia, the anchor of the original petrodollar arrangement, joined the Emberidge project, a cross-border digital settlement platform developed with heavy Chinese involvement, as a full participant in June 2024. The kingdom has not abandoned the dollar. It has not made any dramatic pivot, but it is sitting at two tables simultaneously in a way it was not doing 10 years ago. Saudi Arabia is now a member of the expanded BRICS grouping that includes China, Russia, India, Brazil, and Iran. It participates in yuan-based settlement experiments. Its relationship with Washington is more transactional and less automatic than at any point since the 1970s. The correct framing is not that the petrodollar has ended. The correct framing is that energy trade is slowly becoming less mechanically tied to dollar recycling. The loop still exists, but more energy transactions are occurring outside of it, and each transaction that occurs outside of it is one less automatic structural source of demand for dollars and for US treasuries. The cumulative effect of that erosion is not visible in any single data point. It is visible only when you look at the structure of the Treasury market and ask a question that Wall Street does not like to dwell on too long. Who is going to buy all of this debt? Because the debt is extraordinary. As of May 2026, total US gross national debt stands at approximately $38.9 trillion. The Congressional Budget Office projects that annual federal deficits will average over $2 trillion per year for the next decade. In fiscal year 2026 alone, the Treasury needs to refinance $9.7 trillion of maturing securities, meaning it must find buyers not just for new borrowing, but for an enormous volume of existing debt that is rolling over at current interest rates, which are dramatically higher than the rates at which much of that debt was originally issued. The average interest rate on the total marketable US debt is now 3.373%. 5 years ago, it was 1.491%. That difference, that doubling of the average borrowing cost, is what produces the number that Fortune magazine reported just this month. The US Treasury is currently paying approximately $3 billion per day in interest on its outstanding debt, not per year. Per day, over $600 billion in interest payments in the first 7 months of fiscal year 2026 alone. And here is the structural question that connects everything. That debt needs buyers continuously in enormous volumes. At every Treasury auction, week after week, month after month, for decades, the system has functioned because the dollar's global role created automatic structural demand for that debt. Countries accumulated dollars through trade. They recycled those dollars into treasuries. The loop ran itself, but the composition of that buyer base is changing. China's holdings of US treasuries peaked above $1 trillion in the mid-2010s. By December 2025, according to Congressional Research Service data, they had fallen to approximately $700 billion. China has now been surpassed by the United Kingdom as the second largest foreign holder, and Japan, at $1.2 trillion, holds nearly twice what China holds. The structural buyer that once seemed automatic has become conditional, selective, strategic. The overall foreign demand for treasuries has not collapsed. Total foreign holdings remain substantial. Private investors have partially replaced some of the selling by official institutions. And the Treasury auctions themselves, measured by the bid-to-cover ratio, have generally remained above the critical threshold of 2, meaning for every dollar of debt offered, investors are submitting more than $2 in bids. That suggests the market is functioning. But functioning is different from comfortable, and the stress is visible at the edges. In late March 2026, a set of Treasury auctions for 2-year, 5-year, and 7-year notes went poorly. Primary dealers, the large financial institutions required by law to participate in Treasury auctions and absorb whatever the market does not buy, were forced to take down nearly a quarter of the 2-year auction. The normal average for dealer absorption is around 11%, a tail of 1.8 basis points on the 2-year, meaning the auction cleared at a yield higher than where the market was trading when the auction opened, is a sign of genuine demand shortfall. These are the kinds of signals that the broader public never hears about. They are not catastrophic, but they are the fingerprints of a system that is working harder to sustain itself than it used to. And this is the mechanism that connects everything. The dollar's global role was not just an abstraction. It was the specific source of the subsidy that allowed the United States to borrow at rates lower than any other government on earth, regardless of the size of its deficit. The automatic structural nature of foreign demand for treasuries was a financial cushion that permitted decades of fiscal behavior that would have been ruinous for any other country. When that automatic demand becomes conditional, when foreign buyers become more selective, when the petrodollar recycling loop runs with less volume, when central banks that used to buy treasuries by default now buy gold instead, the United States does not lose the ability to borrow. It loses cheap borrowing. It loses the cushion. It begins paying the market price for its fiscal choices rather than the subsidized price that reserve currency status has historically provided. America does not lose the dollar overnight. It loses cheap financing first. That brings us to the gold. Central banks purchased 863 tons of gold in 2025, according to the World Gold Council. That is lower than the record years of 2022, 2023, and 2024, each of which saw purchases above 1,000 tons. But it is still nearly double the average annual purchases from 2010 through 2021. And 2025 was, by the World Gold Council's own calculation, the 4th largest year of central bank gold accumulation on record. This is not a blip. This is a sustained, multi-year structural shift in how the institutions that manage the world's money are thinking about what that money should be stored in. The National Bank of Poland was the largest single buyer in 2025, adding 102 tons and bringing its total gold reserves to 550 tons, with a stated target to increase further to 700 tons, citing national security reasons. Brazil's central bank elevated gold to the 2nd largest asset in its reserve portfolio in 2025. China's central bank added gold for 8 consecutive months in the middle of 2025. The World Gold Council's annual survey of central bank reserve managers found that 95% of respondents expect global gold reserves to increase over the next 12 months. A record 43% indicated plans to increase their own gold holdings. None plan to reduce them. And here is the language that reserve managers use when they explain this behavior privately. Language that very rarely makes it into press releases. Gold cannot be sanctioned. Gold cannot be frozen by executive order. Gold does not depend on the continued goodwill of any foreign government. Gold does not lose value when the country that issued it decides to print more. In a world where the United States has demonstrated, with Russia in 2022, that it can freeze a sovereign nation's dollar reserves with a phone call, every central bank on earth has had to ask itself a question it did not have to ask as urgently before. How much of our reserve portfolio is exposed to that risk? The answer to that question, multiplied across 149 reporting central banks, is what produces the demand numbers the World Gold Council has been publishing for 3 consecutive years, above 1,000 tons. This is not YouTube gold hype. This is the revealed preference of institutions that have access to every financial instrument ever created. They are choosing to hold more of an asset that cannot be digitally confiscated, printed away, or redirected by political decision. When the entities with the most sophisticated risk management in the world make the same choice at the same time for multiple years in a row, it is worth asking what they see. What they see is not imminent dollar collapse. They are still holding dollars. They are still buying treasuries. They are not exiting the system. They are hedging quietly, without making statements, without triggering market volatility. One purchase at a time, over quarters and years, they are reducing the percentage of their portfolios that depends on the continued unconditional reliability of the American financial system. That behavior is itself a signal, not of crisis, of recalibration. And recalibration, sustained over time, is how reserve currency dynamics actually shift. Think about the pound sterling. For most of the 19th century and the early 20th century, sterling was the global reserve currency in the same way the dollar is today. London was the center of global finance. British treasuries were the safe asset of the world. The pound was what you held if you wanted certainty. And then, over the course of roughly 40 years, between the First World War and the Bretton Woods Conference in 1944, that dominance eroded. Not in a crash, not in a single dramatic event, through wars that drained British fiscal capacity, through the rise of American industrial and financial power, through the gradual incremental process by which the pound became optional, still useful, still held, still traded, but no longer inevitable. The pound did not die. Sterling still exists. London is still a global financial center, but the privilege, the extraordinary, subsidized, automatic advantage of being the world's primary reserve currency, transferred to the dollar over those 4 decades, quietly, without a single announcement. The dollar is not the pound. The United States is not early 20th century Britain. The structural advantages of dollar dominance are far more deeply embedded than sterling's ever were. The depth and liquidity of American capital markets have no rival. The legal infrastructure of dollar-denominated contracts is embedded in global trade in ways that cannot be easily unwound. The network effects of the dollar system are extraordinary and self-reinforcing in ways that genuinely retard the pace of any transition. But the direction of travel is visible to anyone willing to look at the actual data without the emotional need for it to mean either that everything is fine or that everything is ending. The dollar's reserve share has fallen 16 percentage points from its peak over roughly 2 decades. Central banks have bought gold at rates well above historical averages for 3 consecutive years. A growing volume of energy trade is occurring outside dollar-denominated settlement systems. The Treasury market is absorbing a scale of debt that requires continuous, reliable foreign demand at the precise moment that the structural mechanisms generating that demand are operating with less automatic force. The United States is paying $3 billion per day in interest on a debt that is growing by approximately $7.4 billion per day, and the CBO projects deficits averaging $2 trillion annually for the next decade with no credible political path to reduction. None of these facts individually constitutes a crisis. Together, they constitute a structural situation that is materially different from where the dollar system stood 20 years ago, or even 10 years ago. The danger is not that the dollar gets replaced tomorrow. The danger is that the United States keeps borrowing as if global dollar demand is permanent and unconditional, while that demand is slowly, measurably becoming more conditional. Because the moment demand becomes conditional, the price of that demand begins to reflect the true risk of the borrower. And the United States, assessed honestly on its fiscal trajectory, with debt above $38 trillion, annual deficits projected above $2 trillion for a decade, and interest payments consuming a growing share of the federal budget, is not a borrower whose paper should trade at the yields it currently commands, if the automatic demand premium were to erode further. This is not a prediction of collapse. It is a description of a system under structural stress, operating, functioning, still dominant, but no longer operating with the same effortless automatic margin it once had. The institutions that manage the world's money can see this. That is why they are buying gold. Not because they think the dollar will disappear, because they understand that the dollar still dominates, reserves are still mostly dollars, treasuries are still the safe haven. That word is doing more work than it used to. That the margin is thinning, that the future they are managing for is one where the dollar's privileges are real, but smaller than they were. The question for anyone watching this is simply, are you positioning for the world as it was 20 years ago, or for the world as it is actually becoming? The smart money is not panicking. Smart money never panics. Panic is for people who are caught off guard. The institutions that have been buying gold for 3 consecutive years at rates, double the historical average, were not caught off guard by any of this. They saw the data. They understood the mechanism. They made adjustments quietly, incrementally, without announcements. That is the model. Not fear, not dramatic repositioning. Patient recognition that a system in slow transition rewards the people who see the transition clearly before it becomes obvious. The dollar still rules the world, but the word still is doing more work than most people realize. And most people, by the time they realize it, will have already missed the window to act on it.